Welcome to the podcast, everyone. I'm here with Anand Hira, venture partner at IBOS Ventures and founder of Zycara. Today's topic is going to be a very interesting one, particularly considering the financial markets we're in right now, which is like, how do startups navigate the current financial climate? So, Anand, thanks again for joining the podcast.
Thank you for having me, Eric. Glad to be back now for the third time.
Yeah, you're our favorite. You're our favorite guest. So that's why you keep coming on. So
I'm feeling the love for sure.
So let's talk about it right now. I mean, the financial markets are pretty bad, just even from a macroeconomic perspective, right? Everyone's trying to figure out what will the Fed do, and we're also in the startup world experiencing that. You're kind of seeing it firsthand. So, like, what are some of the actual numbers behind what you're seeing in terms of the current financial climate and how it's impacting startups?
Great question, Eric. So in terms of numbers, last February, not too many people are focusing their attention on this, but last February was actually the start of the decline for the grow at all costs companies on the public markets. But the private markets were holding, relatively stable. In fact, still kind of climbing to that effect. But it wasn't, of course, until November, Thanksgiving, when Fed chairman decided that that inflation is real and not transitory, and that we do need to start tightening. So really, since November, on the public market side, we've seen, upwards of between 75 to 90% corrections. Multiples have gone down like dramatically. Price to sales were sky high, and now they're down to a more reasonable, 3 to 7-ish on the public market side. But again, it wasn't until the more recent slide that private markets are now facing the brunt of it. And so what I've seen from the data is roughly an 80% contraction in multiples on private rounds, which is quite, and this is, to be clear, later stage private. Now it's, you're raising at 1/5 the valuation than just even a few months ago. And so it's quite dramatic, not unexpected given where we were coming from, but it's certainly quite dramatic when you look at it that way.
It's very interesting. I think there's a lot to parse from what you just said. In terms of that 80% decline in valuations, are you finding that that's just across the board, or is it because that the market's been so overheated that it's just, maybe I'll use the word emotional response to this overheated market? Or are you finding, hey, some valuations are staying relatively high because everyone sees that there's market potential? So you kind of like separating more or less in this financial climate, the wheat from the chaff.
Sure. No, great point there. In fact, I'll take a step back on this because, we go through these cycles every 10-ish years, right? Where there are pockets of the system that are overheated, and then, one or two world events, or, doesn't really need to be a specific reason, but something triggers and credit tightens up or rates rise, and the tide turns, right? We know late 90s was the dot-com boom, 2008 with the real estate derivatives. Even recently as 2018, maybe it was a precursor, but in 2018, the crypto markets went through a year-long correction there, pretty dramatic, from what was it, like 20K down to 3K. And I like to look at that as a kind of risk-on measure. And so, there have been warning signs along the way. But, to your question on differentiating between companies, yeah, I would say let's call them the well-branded or the more widely known startups at later stages are still, facing a contraction, maybe not as dramatic because there's still demand. But really, in these type of climates, it's not necessarily whether it's an overreaction or underreaction. It is what it is, right? And I would say there's a lot of herd mentality when it comes to investing and just decision making on that front. So, the companies that are more, I would say, in the pre-seed, seed stage are probably not affected as much because their time horizons are much longer. But it's certainly companies that are, pre-IPO or close to pre-IPO, C stage that are feeling the brunt of it right now. And I'll just add to that it's, we really don't know how things are going to shake out, like you said, with the Fed and even the economy, right? With the probability of a recession increasing dramatically over the last few months. We really don't know what it'll shake out, but definitely as long as investors feel that potential, they're going to stick to the new norm, so to speak, where, yeah.
And what is the new norm in your mind in this era?
Great question. Because we went through a period of grow at all costs, high exorbitant valuations, giving lots of cash to companies to just grow and take market share or build a market. And now, whenever we go through a tightening cycle, the mentality does shift to now it's all about profitability, right? And cash flow and sustainability, right? Now, founders who raised, at very exorbitant valuations last year are now having the conversation with their VCs and their advisors that, look, we need to stretch this runway because the next round may not be what you expected from the last round, right? And so it's just a shift from grow to conserve and methodically generate cash flow or find a path towards profitability.
You have an interesting perspective because you're not only an investor, you're also a founder as well. And in this shift from, grow at all costs to more conservative, do you think there's actually value? And you can speak on both sides, right? So that's why I'm kind of curious from the investor perspective, if it's a good or bad thing, and also from a founder perspective.
My personal, and this is very personal to me, I do tend to be a little bit more on the conservative side of things, just given that this maybe it's just my preference towards self-awareness. And like when I do feel that things are in excess or things are just like, whenever you talk to someone, you say, oh, that's so ridiculous, but it's happening, right? When it comes to valuations and speed at which money is flowing, I always like to take a step back and say, look, okay, this is not sustainable, right? Very logically, that's not sustainable. And at some point it is going to change. And so as an investor, I tend to start hedging my bets, right? And I start to, take some off the table if it's on the public market side. On the private market side, you don't really have that luxury, right? But you can at least look at companies with a slightly different lens where you identify founders who are, a bit more responsible with, as part of the due diligence process. You kind of look at how they are looking for the next 1 year to 3 years, 5 years, and seeing how they're thinking about things. And then when you come across, founders who are kind of playing the hype and want to capitalize, you have to evaluate, okay, is this company going to be a game changer in the next, 5-10 years? Where at that point in time, I'd still consider following along on that investment. But I would say overall, my selection process or my decision-making process to invest shifts based on the environment and based on expectations. And then, as a founder, of course, I still haven't reached the luxury of raising at, a Series A yet. I'm still in a pre-seed stage. So it's a little different for me personally, but, just thinking about things, I see other founders who, just need to look at things with practical lens and not necessarily take for granted the environment that they're in. And that's my general kind of observation of what makes a sustainable founder. Obviously there are the one-offs, the WeWorks, I'm not going to say fair enough because that doesn't fit the bill. That's a whole different category. But
yeah,
a lot of companies that no matter what, despite the the clear and present danger that they're going to face in the future can make it, right? But those are, I would say, very exceptional. But your typical startup needs to think of a 5-year horizon as just that, with ebbs and flows. And so that's where I kind of put my lens to it when I evaluate companies.
Interesting. And you bring up, just from a macroeconomic perspective, this is kind of the first time that our generation has experienced more or less very high inflation, right? This was symptomatic of our parents' generation during the early 80s. We're not at that level yet. We may get to it. We'll see. But how do you think, I guess, from the startup ecosystem perspective, we're going to be responding to that? Because this is for us relatively unknown, right? Our generation, a lot of, no disrespect to some older generational founders, but this is relatively new for us. Do you think that's going to have an impact on whether either the investor or the startup founder?
One thing I always keep in mind, it depends on the space. So the answer to your question, it really depends, because technology by nature is deflationary, and it has certain pricing power once established in terms of demand or solving a problem. So I would delineate this between like operating decision making as a founder or as a young individual with their daily lives. That is something to be mindful of, that things are different, right? And so what does that different look like for me in the next couple of years? Maybe I should budget or plan accordingly if my input costs are rising dramatically. Like, I need to know in the future that I should have a hedge for this because this really impacted me today. And then, on an individual level, I don't know, this just popped in my mind, but the baby formula shortage, like things like that are popping up. So, just on our day-to-day basis, our daily lives, we just need to be mindful that, things are not always going to be accessible or easy as they always have been, and from the perspective of our lives. And so it's good to plan in the future for, these type of situations where there are potential shocks to the system, and we need to be prepared for that. Yeah.
Do you think it's interesting you bring that up from both a personal and, let's say, call it professional or startup perspective? Do you think that, and we haven't broached the topic of potentially how a recession will impact and play in all this as well, but whether it's recession or inflation, do we see that maybe I don't want to call it the go-go days of startups are at an end, but it will make a lot more, maybe in the next generation, a bit more hesitant to do startups, whether as an employee or as a founder or even as an investor? Do you see fundamental changes in terms of, like, I don't want to call it the composition, but I kind of leaning towards that in terms of not only the types of startups by industry that will get funded or grow, and also the people that will be involved in them?
A great question. This is something I've I thought about in terms of, this happens every time, Eric. Like, it happened in the 2000s. So during the go-go days, because I do think temporarily, at least, they are gone. When you see young individuals raising tons of money and creating very well established, not established in terms of business, but established in terms of name and recognition, a lot of young individuals aspire to that, right? Because they see, oh, this person's my peer, and I can do the same thing. They can't do anything, or I don't see myself any less than them. And so, let me come up with an idea, let me pitch investors and take my crack at it. So that mentality definitely grew exponentially during the last few years, especially the last couple of years. I do think the shakeout is going to definitely be real, in terms of a lot of potential companies or ideas that maybe, were fringe or very niche that potentially could have gotten funding or are probably not going to get funding just because the market and the financial forecasts for that are hit dramatically. But I also at the same time do think that it's going to come back again at some point. It always does. And it may, we have a very short-term memory when it comes to these things. Just talk to your parents for a bit and just see how many times they've seen it come and go, right?
Yeah.
And like it's something where in 5 years, 6 years, maybe even in a few months, the markets will be in a different place and people react differently and emotions are different. And accordingly, the flow of money is different. So I would say temporarily at the present, for sure, big shakeout. I think a lot of people will reevaluate and maybe go back to that engineering job or, whatever. But I don't see it as something permanent, to be honest. It's just the nature of financial markets that we have. And greed and ambition aren't going anywhere. And so I think it's just temporary for now.
And I wouldn't disagree with you, but I think the ultimate question, and not to put you on the spot since this is getting recorded, is you gave a wide range of this could last a few months or go to 5 to 6 years. So I'm going to be like a CNBC host and say, where's your bet in terms of how long this, let's call it, downturn will last? Is it a few months? Is it a couple of years? Is it less than that? What's your bet right now?
My hot take is, my really hot take is, I think we just saw it this last week. Mm-hmm. I do, in terms of public markets. There is, of course, and not to hedge my bets, but there is the risk of the war in Ukraine. That is something that I can't really account for in terms of what's possible. So from that overhang until that gets resolved, it's not going to be all systems go. But in terms of like how bad things, I think we've priced in a lot of it on the economic front. Because typically when we are in a or when we go through a recession, we don't know until it's passed. Yeah. And so I don't see it being this period being just looking at earnings reports, right? Like I think one of those 75% of companies topped estimates still. Mm-hmm. And yes, there may be a haircut because of oil prices and the short-term inflation that we're facing. I do think eventually we'll pull back to the mean within this year. So I don't see it. I mean, inflation itself will probably be at the target rates in the next couple of years, but markets price that ahead of time. And so I don't think this is going to be like a 2008 type environment or environment where it's going to last more than a few months at best. And my hot take is it actually already passed. So I'll leave it at that.
Well, we won't hold you to that. Don't worry. I won't use this recording in future episodes. So it's all good. I think we talked a lot about the investor side and just the macroeconomic climate, and I always highlighted you're a startup founder yourself. So, and I think you've had some in our discussion hot tips for startup founders to how they can survive this. And I think, is there anything else you want to kind of mention to startup founders that what should they be thinking about during this environment? And I think the other big one, should they even be fundraising? And I'm going to focus on pre-seed right now, because I think you did mention a lot of the private and the valuation drops we've seen is more like, pre-IPO later stage. But focusing on the pre-seed, that's where I think the podcast audience is right now. What should they be thinking about? What should they be doing?
To be honest, customers. Just at this stage of the game, like, from ideation all the way until you start getting, consistent customers flowing in, it's really just putting your head down, only raising the capital that you forecast that you need. Well, I take that back. It depends obviously on, the network that you have, but um, really for me, where I'm at with Zycara specifically, it's just focusing on customers, getting data points, getting information. How can you help them? How can you improve what you deliver to them? Whether you're delivering it to them in the right way. That should be the sole focus. So I would say the finance, of course, is critical, right? In terms of, raising what you need to sustain yourself, your team, and your company. But my advice is to weed out the noise because it's not really relevant to that audience because, again, our time horizons at this stage of where we're at is, 7 to 10 years from now. And I guarantee 7 to 10 years from now, we have no idea where we're going to be at. So there's no point thinking about it like today. But that being said, if they are in the midst of fundraising and they're looking like, I don't think they should be. They should have a frank discussion with an investor who says valuations or this and that or public markets this or that. It's like, look, I'm raising at a pre-seed round. The valuation reflects that. And if you believe in my company and you believe in my mission and my ability to execute, then whether it's 2 million, 3 million, 5 million, 7 million, it's not going to make a difference to them, right? Because that's just a paper napkin number that's going to be highly rewarded in the future or not. Of course, like we just discussed, if it's a later stage company, it's a completely different conversation. But for the pre-seed round or early stage company, it's really focused on customers. And then when you have conversations with investors, the ones who believe in you shouldn't flinch when it comes to, the minute range that a pre-seed company can raise that. So that's kind of my view on it.
I think that's sound advice no matter what the market conditions, right? It's like focus on building a product that your customers will want to buy and getting those customers. And I think that makes 100% sense. I'm going to ask one final question, and then basically that would be the last word for today's podcast. But for those startups, let's say that are in difficulties, right? Like maybe they're they aren't able to fundraise, aren't able to get the customers, and they're in this environment right now. What would you say to either the founders, the investors, or even the employees of that startup in terms of what they should be thinking about in terms of future opportunities or exit strategies?
That's a tough one because it's very individualistic, or based on an individual circumstance. But generally speaking, I'm always of the belief that you have to be real with yourself. And so if you're having difficulty, ask yourself why you're having this difficulty. If it's I like for an early stage, like I said, it's not going to be an external reason. It's going to be an internal reason. Whether it's you're not putting enough focus or attention on speaking to customers. If there's not enough market demand for what you're working on, then maybe reevaluate your approach. And ultimately, in terms of, I have a hard time telling people that they should reconsider what they're working on because it means something to them and they've put in a lot of time and attention towards it. But I would say that it's very important to be realistic and also not look at the short term as the only opportunity, right? If you're finding it difficult, you're finding it challenging, and you're facing, say, a personal financial crunch or relationship strain, whatever it may be, the now is not the end all. There's always a future, and so you can pivot in the short term, and then maybe the why now changes to a later date in time, right? When your company fits the market or there's an opportunity that kind of meets demand. So that's the best general advice I could give. I'm always happy to share my thoughts on a specific circumstance, but generally speaking, I just having a real reflection with yourself on whether it needs to be done now, or maybe I can take care of myself, my family, whatever it may be now through a different means, and then reevaluate it in a year, 2 years, whenever.
I think those are sound words. I think the old phrase, it's the journey, not the destination, and
Absolutely.
there are many pivot points that are critical. So I think that's sound advice to anyone, regardless of the situation they're in. And then thank you again for participating in the podcast, and look forward to future insights from you.
Thank you, Eric. Always a pleasure.